Hello, everyone. Welcome to the Taurus monthly market review for the month of July 2026. During the month of July 2026, we saw a lot of volatility in the market. In global equities, the positioning completely flipped. So for the first 5 months, investors were chasing and heavily investing into high beta names. And that positioning is something which changed during the month of July. We saw KOSPI correcting by nearly 22% by the end of the month, and Nikkei fell by close to 8%. The US indices were mixed, wherein the S&P 500 fell by about 0.13% for the month. Nasdaq was down by about 6.8%. European equities were relatively flat for the month of July. Since earnings have been quite active, and quarter two 2026 results were released during the last majorly during the last week of July 2026. Overall, earnings have been quite positive. So nearly 60% of S&P 500 companies have released their earnings, and their numbers are pretty much in line with what the analysts expected, wherein the profit growth has been more than 20% on a YOY basis. What we saw was that consumer spending continues to remain resilient. However, the market reaction to earnings was quite muted, as big tech hyperscalers continue to invest and raise their capex guidance. They are projected to spend nearly $700 billion for the year, and this quarter reinforced the view that the spending is not going to slow down anytime soon. We saw that the Fed chair Walsh kept rates at 3.5, 3.75. That's the band for the Fed's fund rate. The vote was that of dissents. So there were 3 dissents, and the rates were held steady with a 9-3 vote. Now, these rising dissents are something which are quite unique to the Fed chair Walsh, because the only times it has happened in the past has been during times of Arthur Burns and a couple of other Fed presidents. But for the past 10 to 15 years, votes with such dissents are highly uncommon. We saw that the headline CPI number continues to remain at around 3.5%. As the input costs have been firming up. And these, coupled with the dissents as well as headline inflation numbers, the expectations of a rate hike in late 2026 increased drastically. Lastly, we saw that the US-Iran tensions flared up again. This time, the tensions flared up in a different strait, that is the Bab-el-Mandeb Strait, wherein Houthi forces shot down certain tankers which belonged to Saudi. This immediately led to a reaction in crude, which had been trading close to $70 a barrel, and crude rose beyond $90 a barrel at one point during the month. Finally, by the end of the month, it stabilized at around 84. We saw a lot of movement in commodities as well, wherein after the Fed chair's FOMC meeting, the dollar index fell by close to 1.3%. Moving to equities, there has been a divergence, as I mentioned earlier, during the month of July, where the S&P was relatively flat, but a lot of high beta names saw immense correction. SanDisk, which used to trade, for example, at 2,200 at one point, fell close to $1,000, down by nearly 50% in a matter of 3 weeks. On a broad aggregate index level, the Dow Jones gained about 0.3%, whereas Nasdaq was down by about 6.8%. The key effect was seen in the semiconductor index, where the index tumbled by close to 18% for the month. Europe, as mentioned earlier, gained close to 1.1%, and Nikkei dropped by 8% due to poor sentiment. What's interesting is that money flowed into China, and that's evident from the from the MTD performance of both Hang Seng and HS Tech. Both of these indices rose by close to 13% for the month. Moving to fixed income, so Treasuries saw a surge across the curve, right from the shorter end at 2 years to as much as 30 years. The entire curve shifted upwards. The 10-year closed at around 4.75, and the 30-year was trading at around 5.25 by the end of the month. Yields rose as the Fed decided to keep the rates steady between the band of 3.5 to 3.75. What it also did was raise the probability of a 25 bip hike in September to close to 67%. Globally as well, major central banks, that's the BOJ, ECB, and BOE, kept their rates on hold. Credit spreads, as well as long in duration, faced headwinds, mainly because of the inflation risks, as well as energy input volatility. Looking at other assets, gold rebounded in July as there was demand for the safe haven. And again, it closed higher by about 1%. The dollar index closed lower by about 1.3%. This was mainly because of the possibility of a rate hike in September, which seems to have firmed up. We saw intervention by the BOJ in yen, and at one point, yen was trading at close to 164 levels, but post-intervention, it's now trading at around 156, 157 levels. Oil prices rallied sharply during the month as now both the straits are facing conflict and turmoil, and it's not easy for the oil-producing countries to ship out either oil and gas from either of these straits. Lastly, cryptocurrencies were relatively constrained in July. They were weighed down by long in treasury yields and managed to close the month at close to 63,000 for Bitcoin. Looking at the fear and greed index, it remains firmly in the fear territory. The inputs of the index, are, as mentioned on your screen, are 7, where the index takes into account the momentum, the strength of various stock prices, the breadth of the market, the values of put and call option or the put and call ratio, which shows how much fear is in the market and how the investors are hedging their bets, the demand for junk bonds, the market volatility index or the VIX, and overall demand for safe haven. We talk about few ideas and concepts and how we see portfolio positioning moving forward. Over the past 1.5 decades, it's been a one-way bull market where we have seen global investors allocate increasingly towards public markets as well as private markets. So equities as an allocation is something which you can see in the dark blue and light blue line and on the left chart, and that has steadily trended up since 2010. What this has done is that due to the outperformance of US stocks and the US tech sector, a lot of this money has flown, has come into predominantly a single sector. This has raised questions about the valuations of different stocks and companies. The Shiller PE ratio, which calculates the PE ratio based on the earnings of the past 10 years, is close to 40. And again, these are extremely elevated levels. The Shiller PE ratio is something which is there on the right side of your screen in dark blue line. This has happened against the contrast or a labor productivity which has sort of stagnated right from 2015 until now, where we have not seen labor productivity keep up or keep pace with the rise in this PE ratio. What it eventually means is that although a lot of money is flowing into is coming into the AI and the tech sector, we are not seeing the result or the productivity increase of these efforts or of AI, at least at the moment. As mentioned earlier, the AI capital expenditure has been increasing steadily. The orange line, which you can see of hyperscalers, indicates that companies are now spending more than their free cash flow. So Google, for the first time, exceeded the amount it spends on its AI initiatives. So the free cash flow actually went negative for the first time in more than a decade. What this implies is that unless investors see returns of the money being spent by different hyperscalers into AI, it's going to compress the returns or the ROE for different investors. In fact, analysts are predicting that the ROE for mega cap tech stocks are likely to decrease by close to 7% in 2027. Ultimately, this is something which will impact the stock prices as well. The mega cap tech ROE is something which you can see on the right side of your screen. So what do investors do when they want to diversify away from a particular sector, and if in case there is a drawdown in the tech sector? This is a question which gets asked fairly frequently to us. And looking at past data, what it indicates in the table which you see on the left is that during a tech drawdown, so on an average, during a tech drawdown of close to 26%, a portfolio which was diversified into commodities, so that's S&P GSCI, gained about 23%. Gold gained close to 9.8%. Real asset stocks lost some money, but overall the index moved up by 2%. What it implies is that for investors, it's extremely important to diversify their portfolio away from a single sector into broader allocation, which goes into different commodities. And it's also important for investors to look at different ways to allocate to the tech sector as well. Option overlays, such as buying long-dated call options, is one such strategy which works quite well in the overall portfolio. At the end of the day, the investor either loses the premium or he enjoys the benefit, but then at the same time he's protected in case of any severe downside in either single stocks or the index. What also helps is looking at portfolios with a different lens of equity long-short strategies. That is something which is highlighted in the right chart, where the dark blue line shows the equity long-short portfolio returns, and the light blue line shows their allocation or the beta that they generate. Now, what it implies is that these funds tend to deliver better returns on a risk-adjusted basis compared to purely allocating funds towards either single line equities within the tech sector or broader indices. The key themes that we are looking at for the month of August are two. One is the changing monetary policy under the new Fed chair, Kevin Warsh. What we saw in July was the second meeting of the Fed chair. The first meeting also had some dissenting members. While at both the meetings the outcome was the same, that the FOMC members chose to maintain rates at the current band. The increasing amount of dissent is something which may be looked at by investors as an indication of possibly raising rates if the other FOMC members keep their stance. What would also be important during the month is looking at the inflation data, that's the CPI and PCE data. These are the same metrics that the FOMC members look at while arriving at interest rate decisions. The impact of this is that a persistent hawkish stance of either different press conferences or of implying by either suggesting to the market that there could be a rate hike around the corner, is that the bond yields could be pushed higher, and it may impact the stock rallies that we have seen. On the other side, if there are clear signals to the market that the rate is going to be stabilized at current levels, it may be supportive of equity valuations. The second theme that we are observing is that of geopolitical tensions and energy price volatility. What we have seen is the war was being fought over the Strait of Hormuz, but now a new front has opened, and this complicates the scenario even further. Renewed hostilities in this Bab-el-Mandeb Strait may spark further shipping disruptions and can cause volatile swings in crude oil prices. We have already seen this indicating by the data where the July S&P Global Flash PMI shows that the supply delays are running at nearly 4 years, and this is also pushing up input cost inflation at a 14-month high level. A spike in energy prices can reignite any kind of worries that the Fed has about inflation, because energy prices at the end of the day have a multiplier effect on the overall economy. Any escalation could also impact the demand for gold, the US dollar, and treasuries. We'd like to highlight the portfolio allocation suggested based on risk profile. For the risk profile, the current allocation stands at 50% into fixed income, 15 into equity, 25 towards alternates, and 5 each towards commodities and cash. For balanced, it's 25% equity, 25% fixed income, 40% alternates, and 5 each in commodities and cash. And for aggressive, it's 40 equity, 15 into fixed income, 40 into alternates, and 5% towards commodities. We will update these as and when the market moves. And if we see any changes, these will be shared in further monthly market reviews. During this week, we are going to see a number of economic releases. So on Monday, that's today, the PMI data would be released. On Thursday, it will be the initial jobless claims. And on Friday, it will be the non-farm payrolls which would be released. Earnings are something which would keep the market busy. So on Monday, it's going to, amongst the key companies, on Monday, it's going to be Palantir. On Tuesday, AMD. On Wednesday, SanDisk, Western Digital. On Thursday, MP Materials. We are also going to see earnings for the first time of SpaceX. And just after a few days, there would be more shares which will be unlocked for the company, which may come to the market. That's it from my end. Thank you so much for your time, and thank you for attending the monthly market review with us.